Hey everyone, if you've been following the markets recently, you already know we've had some wild swings in fintech and tech stocks. Today, we're diving into one company in particular that has captured the attention of hedge funds, retail investors, and market commentators alike: Fiserv, ticker symbol FISV. This stock has had a year that many would call catastrophic, and yet there's a case to be made that it could be one of the most interesting opportunities in the market right now. But before we dive into the numbers, let me ask you this. If you're thinking about retirement or even planning for financial freedom down the line, have you ever wondered if there's a way to spot opportunities that could accelerate your timeline? Stay with me because today we'll not only break down Fiserv's dramatic plunge and what it could mean for investors, but we'll also touch on how decisions like this tie into the bigger picture of retirement planning and wealth strategy. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Fiserv has experienced a crash that is difficult to comprehend. From its peak earlier in the year to recent lows, the stock has fallen nearly 75%. That's right, a three-quarters loss in value over the course of less than 12 months. Now, a drop this sharp is rare, especially for a company of Fiserv's size. We're talking about a $33.2 billion fintech powerhouse whose technology underpins payment solutions for thousands of businesses. To put this into context, it's the kind of company many investors would consider a blue-chip name within the fintech space. And yet, despite its prominence, shares have tumbled to a level not seen in more than 8 years. One of the key reasons behind this decline? Lowered full-year earnings guidance. Management has indicated that revenue and profits are coming in below expectations, signaling a rough road ahead. On top of that, Fiserv has faced significant challenges with its Clover POS platform, particularly in customer relations. Issues with fees, service reliability, and overall satisfaction have created hurdles for long-term growth. Here's where things get interesting. Even amid the chaos, hedge funds were actively buying Fiserv shares in Q3. Several large funds saw an opportunity after the historic sell-off and decided to initiate or add to positions. Now, this isn't to say that these funds have escaped losses. By Q4, the stock dropped another 52%, putting anyone who bought in earlier in a tough spot. But the story of hedge funds is always about timing, patience, and risk management. Big money rarely makes a single all-in bet. They often scale into positions over time, taking advantage of volatility. It's a classic case of buying the dip. And while some investors may have recoiled from the falling stock, others may see it as a rare chance to enter a fundamentally solid company at historically low valuations. So why would anyone consider buying a stock that's already lost three-quarters of its value? First, the valuation is striking. Fiserv now trades at around 9.45 times trailing PE and just 7.2 times forward PE. For comparison, many fintech peers trade at significantly higher multiples. From a purely value perspective, the stock is cheap. Second, the company's issues, while serious, are potentially fixable. Full-year guidance was lowered, yes, and there are challenges with executive decisions and prior cost-cutting measures. But the company is actively taking steps to correct course. They are exploring AI integrations, shuffling executive leadership, and trying to improve customer relations with the Clover platform. Third, the market often overreacts to short-term pain, particularly in tech and fintech. When a large established company experiences a bad quarter or two, sentiment can swing wildly, driving stock prices lower than what fundamentals might justify. That's exactly what we may be seeing with Fiserv. Now it's not all sunshine and rainbows. Fiserv has a significant debt load of around $30.2 billion, which could limit its flexibility when it comes to investments, acquisitions, or aggressive turnaround strategies. Legal challenges add another layer of risk, particularly when it comes to customer complaints or regulatory scrutiny. In addition, the broader macroeconomic environment isn't exactly a tailwind. Rising interest rates, slowing consumer spending, and global economic uncertainty can all weigh on fintech companies that depend on transaction volume and merchant adoption. But here's the key question: how much of this is already priced into the stock? At roughly $61 per share, investors are clearly betting that some or most of the bad news is already reflected in the current price. If management can execute even partially on its turnaround plan, the upside could be meaningful. One fascinating angle to explore is the behavior of institutional investors. Hedge funds have been buying amid the decline, But they aren't gambling blindly. They are making strategic, calculated moves based on both fundamentals and market sentiment. Historically, when blue-chip stocks tumble sharply, the smart money looks for entry points that offer high potential upside at reduced risk. They are not necessarily trying to hit a home run immediately. They are positioning themselves to benefit as the company stabilizes, improves its operations, and potentially resumes growth. For individual investors, the lesson here is patience and research. Jumping in because a stock is cheap isn't enough. You need to understand the company's challenges, its plan to overcome them, and the timeline over which recovery might occur. Fiserv presents a textbook example of a company where risk and reward are both amplified. Now, let's pivot slightly because there's an important lesson here for anyone planning for retirement. Many people think retirement planning is all about picking the best stocks or ETFs, but there's a subtle yet critical distinction: the difference between accumulation and distribution. Accumulation is about growing your portfolio, taking on risk to maximize returns over time. Distribution is about safely taking income from your investments once you stop working. Even the best stock can be a liability if you are drawing from your portfolio to live. Sharp drops like Fiserv's can devastate income streams if you need access to cash. That's why millions of Americans are reassessing their retirement timelines. They're asking three critical questions. The stock is deeply undervalued, has major institutional interest, and is actively working to fix its problems. Yet the challenges are non-trivial. High debt, customer relations issues, and legal risks are all factors to weigh. For investors willing to accept short-term volatility and bet on a potential turnaround, Fiserv represents a classic value play. For those seeking stability or guaranteed income, especially if you're planning for retirement, it might be safer to wait until the company shows clearer signs of recovery. One thing is clear: stocks like Fiserv highlight the delicate balance between risk and opportunity. They remind us that investing isn't just about chasing gains, it's about understanding the story behind the numbers. To wrap things up, Fiserv has endured a historic sell-off, dropping nearly 75% from peak to trough. Yet it remains a blue-chip fintech company with a path to recovery. Hedge funds have been active buyers, signaling that the smart money sees value at these levels. At the same time, challenges abound, from customer dissatisfaction with Clover POS to debt to legal risks. But for those willing to dig into the company's fundamentals, understand the risks, and commit to a longer-term perspective, Fiserv could be an opportunity worth considering. Finally, the bigger takeaway for all investors is this: retirement planning isn't just about returns. It's about timing, risk management, and portfolio design. Even solid companies can become a problem if they aren't approached strategically, and even volatile stocks can be valuable if they align with a broader plan. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.